the themes that I'm picking up from each one of you in your initial comments. One, of course, is family-owned businesses looking at ways of exiting at this point in time. The next generation perhaps doesn't want to be, doesn't necessarily want to get their hands dirty, wants a way out. Consolidation and, fragmented sectors being put together. That's another theme that seems to be playing out. Global companies looking at India from a local strategic perspective. That's the other theme that's playing out at this point in time. If I were to ask you about valuations, because that oftentimes is the impediment, is this a buyer's market today? I mean, you've been cautious about this. Are we looking at deal flows from a buyer's market perspective?
Shereen, I think if you look at what was clear is the time gone by. So when I look at 24, it was definitely a seller's market. We had IPO markets which were crazy. We all got exits. I think each one of us, we had more than 4 IPOs. We still have another 3 in the... It's gotten tighter now. So when it's a seller's market, buying was very difficult last year. So of course, each of us has teams that are motivated by making new investments and exits, but the focus was on driving exits, cash, and DPI. Of course, our teams, deals don't happen overnight, as you know. It takes years to get a deal done. I would say we did do 2 or 3 deals last year. We normally would do 5 or 6. So the rate of deployment slowed down.
Do you believe that it's likely to slow down further or pick up?
Yeah, so my sense going in the past was, despite that, we did stuff, you had huge conviction. So you pay a higher price, the amount of margin for error goes to 0 or close to 0. So your level of conviction, you spend a bit more time. I think going forward, what this has done is, and I would say definitely for us, I would guess Mukesh and of course, OTPP and our other friends with Sumeet, our pipelines are extremely strong, right? So we have 20 things in the hopper, which we've been working for more than a year. I do think the public markets eventually are an indicator where the private markets are going to go. And it hasn't been the most healthy start to a year. I think prices rightly will correct, the multiples will compress, and the second half of 25 will be a buyer's market much more than a seller's market. Okay, so Mukesh, let me understand from you, how are valuations looking at this point in time? Are you also holding back or sitting on the fence waiting for things to turn as far as valuations are concerned?
I think if you look at India's valuation, on the large cap side, in fact, we are below long-term averages. So on large cap side, it's fine, but I think the frenzy which happened in the mid cap and small cap, primarily driven by large domestic inflows, our biggest competition actually for deals was public markets. It was not other PE firms, because we do only buyouts, and when we see the founders having a valuation which is 2x of what we are offering in the IPO market, it was very difficult to convince them. But off late, I think what is going to happen is supply is going to outstrip demand, and the supply of capital also in form of number of IPOs which are coming, and with this correction, I think I agree with Manish that second half is when, a lot of people who are looking, I know some of the IPOs have been pulled back. So it will not be as easy to do an IPO as it was earlier, and that was when...
pulled back on account of the volatility that we're seeing?
Volatility and I think the valuation what they had in mind.
The expectations, the mismatch in expectations between what the founders expect and what the market's willing to offer at this point in time.
Yes.
Sumeet, are you seeing that as well? Do you expect things to pick up in 25? And do you also believe that this mismatch of valuation expectations is perhaps going to see more IPOs fall or being a casualty to this misalignment on expectations?
So I think if you see globally, as investors sitting globally, still India is, I think, on the expensive side on a relative basis, what they are seeing. So I think the markets will be subdued. And I think to each seller, if people like, even in our business, if a business needs to be sold and we need liquidity, and we're getting 10% lower than what we want, we would go ahead and do it. And I see the same behavior from, other motivated sellers and buyers respectively. But I think it will be a little subdued environment seeking liquidity.
Vivek?
India's pricey. We know India's pricey. I think there are 3 lessons we've taken from it, just observing outside in, right? One is, India's equity risk premiums at all is now getting back to a high, thanks to currency depreciation, thanks to other risks associated with it. And as a result of that, it's actually quite difficult to, even with buyouts, you need a 2 in front of your returns. You need a 2 in front of your returns, and anyone going out there raising capital who says otherwise is probably, is tricking themselves. LPs will tell you, you need a 2 in front of your returns to justify the prices at which you're buying. So that's one. The second is, look, we went from a regime of, paying 4 to 6 times, 8 to 10 times. Now we're paying 12 to 14 times. Guys,
Yeah.
we know what we're buying at. And therefore, what has happened as a result of that is people are moving to quality. You're better off buying a platform of higher quality at a slightly few more turns multiple that can use the thesis that Sumeet talked about or Mukesh talked about as a platform to acquire other businesses, as Care Hospital has, or some of the other examples, versus buying a fixer-upper at a great price. So this is not a market where you really want to end up buying a fixer-upper.
What does the pipeline look like? And I'll get each one of you. Do we have more fixer-uppers at this point in time, or do we have the high-valued quality bets? Mukesh, you want to come in on that?
For us, what we thrive is, what we state to our LPs also, we look for deal complexity with great businesses. That's what we
Deal
thrive.
Complexity with great businesses,
Yes.
okay.
Where there's a motivated seller, where there's a cross-border transaction. We bought VFS when there was COVID. We bought Care Hospital where there was a minus frivolous case going on. IGI where Fosun was the seller. So I think in those situations, as Sumit also rightly said, there's no option but you have to exit, right? And that's where we come in and move at speed and certainty to get this business in our favor. So, and if we see that we can create value, whether you pay, any deal, if you pay 10-15% higher, but if you have the conviction to create value, I think if you have to go wrong, you will go wrong even with the 10% lower value. So I think what we thrive for is deal complexity, and when we see that, we move at speed.
But let's address that value question and the value issue then. I mean, what are we talking about in terms of the kind of value that you hope to create, say, over the next 5 to 7 years? The returns that Vivek was talking about, that Sumeet was talking about. I mean, what should we realistically expect now in terms of value creation as well as return generation from an Indian asset?
I think our value creation journey will remain the same. Like Emphasis was declining 20 quarters in a row. If I would have bought Emphasis even 10-15% higher or 20% higher, we would have made the, what returns we have made. And I think we got, in terms of IT services alone, we have got more than 50 clients from Blackstone portfolio. So I think whether that will stop, no, that will continue going forward. In Care Hospital, to Sumit's point, what you've done in insurance brokerage, we've done in hospitals. Again, you've created a platform. If you buy 10-15% higher, but the other platforms which you're, adding on to it, I think that will continue. And to Manish's point, after some point where you see the margin of error is too low for all right bets to go right, that's where you put a pause and say, let's wait and watch.
So it's not a pause for you at this point in time?
Not a pause for us. So I think personally, as I stated, IPO is a good way to start, but that's, it's not a good way to exit, right, finally. And especially for promoters of Indian companies, for markets have become quite matured enough for PE firms to exit completely in public market. But for founders, if they have to sell a controlling stake, it becomes very difficult to exit in public market. So at right point, I think this will move again towards private market. And for us, certainly, we see opportunities going forward.
So not
This is a man with a listed company with lots of money to deploy. So all families in this room should be coming to him, and Mukesh is the man of the hour.
Let me get closing comments from each one of you, because I think we're pretty much at the end of our time. As we look at the India story, and I think everybody's talked about the opportunities that present themselves, how exciting it's looking, what it means in terms of a return perspective, etc. What does the India premium today look like? Mukesh, let me start by asking you.
I go to LPs and every time they say India is trading at it's trading at 100% premium to UK market. It trades at 20 times P, UK market trades at 10, and they give example of China and they give examples of Korea, etc., which all trade at 10 times P. And my answer is, if you look at returns of India for the last 30 years, 20 years, 10 years, globally, all the markets, just take the returns of all the markets for 30 years, 20 years, 10 years. India, there are only 2 markets who have delivered double-digit returns globally, US and India. And all the other markets are low single digits. So even if you correct India by 15%, 20%, it will still outperform all the peers. So I think one great thing about India is the reason why the multiple is also high is the growth which this country exhibits and the stability of the government and the spirit of Indian entrepreneurs to even work in difficult environments and create value. Obviously in mid-cap and small-cap there has been a huge spike and there has been a correction, but I think the growth will continue and India will continue to trade at premium to other global markets given the growth it has.
Manish?
I think Mukesh has answered it well. My point is when someone talks about the India premium, we should always, as we do with the LPs, remind them of the India growth. I mean, when you talk about a 6 or 7% terminal value in your models, people are shocked. I mean, how do you do that? So it needs a higher. I think the more important aspect is not everybody's made money in India, right? So at the end of the day, to Mukesh's point, I think you've got to trust the GP that you're deploying capital behind. It's not about riding the beta, it's how do you drive the alpha. Whether, as Vivek said, it's driven by operating partners, there's an angle which has to be related. At the end of the day, this is a people business. You've got to get a bunch of guys who know you can differentiate, because otherwise everybody should be giving supernatural returns. So what I'm saying is, in a market like India, which is not cheap, there's a reason at the macro level why it's not cheap. But in order to really make money at a consistent level is very difficult. And I think one of the core aspects, which I think is bimodal, is what Deepak said earlier about the governance. So the only thing, we may or may not have made a lot of money, we luckily have. The one issue I take pride in is we haven't called a promoter wrong. We've never had a situation of theft or we've been very, that I think is critical. And I think given where markets are, people are also realizing it's better to show the extra $10 on your P&L rather than taking out somewhere.
No, I think the governance premium, that point is well taken. Sumeet, the India premium?
So I think on a normalized basis, I'm not taking a static view of a particular quarter. On a normalized basis, I think it has sustained over the last 20, 30 years. I think on fundamental NPV Excel sheet basis, I think it is justified. Second, I think it's the same Fidelity Wellington investor sitting in, overseas buying Suzuki stock in Japan and Maruti Suzuki in India. So it's the same buyer who's pricing it differently. So I think it is justified.
The thing that gives you the most confidence about India and the one risk that you would be most mindful of?
The one blip I'd be a little concerned about is, you talk to LPs around the world and they'll say, I love India, I want to be there, there's just not enough investable opportunity. So it is actually interesting, the industry has become a bit of a barbell. You've got some people on the panel here who are actually out there raising capital, and you have a huge long tail that can't raise any from institutional investors. So that's one thing. In other words, you could end up with India with a highly concentrated manager base that actually represents 60, 70%. It could be a market where you have 6 or 7 managers represent 70% of the market. That's one. I don't call that as a risk, but frankly, it does. It creates a concentration that I think for some managers, some LPs will say, look, I love India, but I can't write big enough checks to enough people. The stuff we love about India, obviously, is I'd say on a more lighter note is the optimism.
I hope we continue to surprise the optimists as we move forward. But many, many thanks, gentlemen, for joining us here today. And thank you very much for your insights and your time. Thank you very much, ladies and gentlemen, for joining us this morning.